There are two interesting formulas that this chapter goes over regarding growth and when a company is going to run out of money. So we illustrated here that credit terms can cause you to run out of money, but also it's the growing nature of the company that's requiring it in combination with the credit terms. So it's useful to know how much can you grow before you need money from outside. So the first formula answers this question. Okay? How much annual growth can you have in sales before you need external financing? Okay, and external financing is basically equity or debt. Okay, so this formula is as follows. I'll write it out, then I'll put all the variables down and you can have a look at it. And let's see, it's actually quite useful. It actually does apply to a lot of the real world companies, and if you ever tried to run it on one of them, you'd see it wouldn't be too far off. Okay, so there we go. So delta sales is the change in sales forecasted. Okay, where S is the starting sales or the base sales number. Okay, so essentially another way of saying this is that this formula here is the growth in sales. So the maximum growth you can take in sales is going to be calculated by this formula, where P is equal to the net profit margin. So this is a percent of sales. D is the dividend payout ratio. Okay, and T is the total assets divided by your base sales. And DE is, as you would expect, it's debt to equity. So it's that ratio. So if you plug all of those numbers in, it will give you a certain percentage. And if the percentage is 20%, what that says is you can grow this company's sales by 20% next year and not have to get external financing. If you grow by 30%, then you're going to need to get external financing. Okay, so that leads to the second question. What's the amount of financing? So how much external financing do you need? So if you're below that number, then technically you don't need anything. But if you are above that, this will tell you the dollar amount that you will need to raise. So the amount needed is calculated by this: assets over sales times the change in sales. So this is your forecasted growth, minus debt over sales times the change in sales. Okay, and run out of room here, so I'll just put then minus at the next line P, which is your profit margin, times the projected sales. So that's the next year projected sales, times 1 minus D, which is the dividend payout ratio. Okay, so if you plug that in, this will give you a dollar amount calculation of how much money you need to raise by debt or equity, and whether you choose to do it by debt or equity depends on what your capital structure goal is.